Good day, everybody. Chris Herline here of REAP Financial. Hope this message finds you well. Today is October 18th, 2024, coming to you with this week's Wealth Report. As many of you know, this is our Roth conversion season. We do a lot of Roth conversion for families. This time of year, obviously, we got to get it done before the end of the year. But I also want to talk about 3 backdoor Roth IRA strategies to consider before the end of the year as well. As we approach year end, it's time to decide how much you want to put in Roth IRA accounts and choose potentially from one or more of 3 different backdoor Roth IRA strategies. Now, at the top of the year, the IRS announced that in 2024, the new contribution limit for one of these 3 backdoor Roth IRA strategies is up to $46,500. Now, after the 2020 election, there was a lot of talk about shutting down the backdoor Roth strategies. I was talking to you, our clients. I was talking to our KLBJ, our KXAN viewers all about this. I was concerned. But fortunately, the proposals, they died in Congress and they haven't been revived because of their unpopularity. These backdoor strategies, these things we talk about with our very own clients, are safe for you to exploit for at least another year. My hopes there are probably much longer. And the reason these backdoor strategies are needed is because of restrictions on Roth IRA contributions. Now, I want to be clear. This is not a conversion I'm talking about. These restrictions really apply to Roth IRA contributions, new money in. The first restriction is that taxpayers with adjusted gross income above certain levels, well, you aren't allowed to contribute any amount directly to a Roth IRA at that point. But in 2024, the Roth IRA contribution is phased out for married couples, those of you filing jointly, when your AGI is between $218,000 and $230,000. For those of you that file single, it's phased out when your AGI is between $138,000 to $146,000. So for those of you that your income exceed the phase-out levels I just mentioned, you're not allowed to make direct Roth IRA contributions. But taxpayers who want to contribute to a Roth IRA but have too much income can use what I call the original backdoor Roth IRA strategy. So let's talk about what that looks like. Step 1 is to contribute to a traditional IRA. Now, if you're over those income limits, it probably won't be a tax-deductible contribution because taxpayers with higher incomes who are covered by, let's say, an employer retirement plan, you also can't take deductions for contributions to traditional IRAs. But you can make what's called a non-deductible contribution. Step 2 is you wait for a while, and after that contribution has been made to that traditional IRA, well, then we can convert it, even in the same year, to a Roth IRA. So when that traditional IRA contribution that I mentioned wasn't deductible, there's no tax when the contribution is converted to a Roth IRA. Why? Because it's already after tax money. Any accumulated investment income and gains that are part of the conversion, well, that must be included in your adjusted gross income. Now, after those 2 steps, a taxpayer who wasn't eligible to contribute to a Roth IRA all of a sudden has a Roth IRA. I always like to be clear about this. The IRS, they really haven't issued any guidance or rules on this backdoor Roth IRA strategy. We always recommend waiting for a while after the contribution to the traditional IRA was made before doing the conversion, so essentially not doing it the same day. And that's because if the actions are taken about the same time, the IRS, well, they could decide it doesn't like the transaction. It might argue that the 2 transactions should be combined and maybe considered an illegal Roth IRA contribution in disguise. However, this strategy has been around for many, many years. And because the IRS hasn't issued guidance, well, there's no safe harbor waiting period. But we tell clients the longer you wait, we believe the safer you are. Now, this conversion should be done directly by the IRA custodian. So that may be Fidelity or Vanguard or Schwab for you. And you want to do this without taking any possession of that balance. Because if you take possession, you must complete the rollover within 60 days. Also, you're only allowed one 60-day rollover every 12 months. The limit could be a problem if you plan to do this every year or if you want to do a different 60-day conversion for whatever reason. In our opinion, it's safer just to have the custodian make the transfer directly. And for many of you, you can just initiate this online. So the benefit of this backdoor Roth IRA strategy is limited when you already have one or more traditional IRAs with pre-tax money in them. So talking to those of you that already have IRAs that are funded. And this is very important because the IRS regulations don't let you segregate non-deductible contributions and say, well, you only are converting that money tax-free. Instead, you add up all your traditional IRA balances and determine the percentage of the aggregate balance that consists of the non-deductible contributions. Anybody confused yet? Yeah, this can be a little bit more complex. This is when we want you to consult with your advisor, consult with your CPA. But in finishing the point, when you convert less than the aggregate traditional IRA balance, you are treated as converting a pro rata amount of the pre-tax and after-tax money that is in all the traditional IRAs, even when you convert the full amount of one IRA. So if you already have a traditional IRA with pre-tax money in it, be aware that part of the conversion will likely be taxable. The second restriction that makes people go after this backdoor IRA strategy is that the annual limit on IRA contributions is rather low. Even when your income is below that phase-out range for contributions that I mentioned, the maximum IRA contribution is $7,000 here in 2024. And if you're 50 or older, you get a $1,000 catch-up contribution. It's an additional $1,000, so pretty much a total of $8,000 per person. So in comes the second backdoor Roth IRA strategy, and this lets you dramatically increase the amount of money that you can put in a Roth IRA. So it sometimes is given names like Mega Roth IRA, or I've always called it the Mega Backdoor Roth IRA strategy. So here's how it works. To use this strategy, you must be employed, or you can even be self-employed, and participate in a 401k plan that allows what's called after-tax contributions. Many plans offer this to employees who are already maximizing their pre-tax contributions. The pre-tax limit here in 2024 to max out that 401k is $23,000. And if you're over 50, you can do an additional $7,500 as a catch-up. So that's your catch-up contribution. So let's say you've already maxed out or you're getting ready to max out your 401k for the year. Well, I commend you, but the issue is this. Many people don't know that the tax code actually allows additional after-tax salary deferrals that exceed the pre-tax salary deferral limit. This additional deferral is going to be included in your gross income and taxed on the year, but once it's in this account, the income and the gains can be compounded tax deferred. So if your 401k plan allows this, the maximum total contribution to a 401k for a worker here in 2024 is $69,000, plus an additional $7,500 catch-up contribution for those of you 50 and older. Let me be clear, that maximum includes pre-tax employee contributions, employer contributions, and after-tax employee contributions. Under this mega backdoor Roth IRA strategy, what I'm telling you is somebody 50 or older can make after-tax salary deferrals of up to $46,500 here in 2024 after maximizing their pre-tax deferral. That assumes there's no employer contributions there. But the bottom line is this. For those of you in your highest earning years still working, this allows you to take what potentially is discretionary income and put a substantial amount above and beyond into the 401k well beyond the standard limits. So if we want to maximize the benefits of this strategy, we would hope that your 401k plan would allow what's called in-service distributions. A lot of families don't even know this is an option, but an in-service distribution is a distribution that you make while you are still working for the employer. Generally, 401k distributions are allowed without penalty after you retire, maybe you move to another employer, if you have a spouse that passed away or became disabled. The tax code allows for in-service distributions for those of you that are already in your 50s, and many plans allow in-service distributions for active employees after age 55, and in most cases, age 59 and a half. So when your 401k plan has these two provisions, you have after-tax salary deferrals that you've made to your account, Now, after these after-tax deferrals have accumulated, now here comes the strategy. After the after-tax deferrals have accumulated, you can then direct the plan administrator to make an in-service distribution by rolling over the after-tax contributions to a Roth IRA. That's right, you can have this rollover done directly between your plan administrator and your Roth IRA custodian. So what you're doing is you're rolling over just the basis of what you put in, not the gains, but these large sums that you're able to put in after tax. And unlike IRA rules, your 401k rules actually allow you to direct that only after-tax contributions be distributed when the account also has pre-tax contributions and investment returns in it. That's a really cool feature of the 401k. Now, when you go and roll over these after-tax contributions, it's tax-free because the money had already been taxed when you put it in. Once in the Roth IRA, now this money is treated the same as any other Roth money. It will forever grow tax-free. Now, a little side note, most 401k plans, they limit the number of annual in-service distributions. So keep this strategy simple. Maybe just consider doing an in-service rollover distribution once a year. Or maybe you're a couple years out from retirement, and as I mentioned, you may wait till you retire because this plan still can be executed even if your plan currently doesn't allow for in-service distributions. The difference is that the after-tax contributions, they can't be rolled over to your Roth IRA until you retire, until you separate from service of the employer. So throughout the years of doing this, you're likely to have accumulated investment income and gains in this account. So to avoid the taxes, you'll have to be sure only that after-tax amounts are rolled into the Roth IRA. Now, for most of you that have a 401k that's administered by a reputable third party and maybe held out a household name custodian, the good record keeping by you and the 401k plan administrator are key to making this strategy work. Now let's talk about this third backdoor Roth IRA strategy. Now this one's really cool. The third backdoor Roth IRA strategy is to set up a tax-free account for your children or your grandchildren. This can be a real nice addition to your already existing estate plan. A lot of you may already be retired. A lot of you I know are already retired, and so maybe you can't set up a Roth IRA for yourself, but you might be able to do this for a grandchild. So let me pitch an idea. Suppose you have a grandchild in high school or college who's working during the summer or even part-time during the school year. Well, if they're working, that grandchild has earned income and is eligible to contribute to a Roth IRA. Of course, I believe that very few people that age are going to take the relatively small amount of money that they earn and contribute it to a retirement fund. Somebody in their teens or their early 20s, we would hope they would, but again, they probably don't have a lot of discretionary income. But here's the interesting thing. Anyone can make contributions to someone's IRA, whether it's a traditional IRA or a Roth IRA. Just be aware that the total contributions to the IRA for that individual can't exceed the annual limit, and the owner of the IRA must have earned income at least equal to the amount of the contribution. So if they're making $4,000, you couldn't contribute $7,000. You could contribute up to what they earn. If they're making well over the top contribution limit, potentially you can max it out. So you talk to your son or your daughter, or you talk to your grandchild and you say, hey, how much are they earning? And you're able to contribute the lesser of the amount and the year's IRA contribution all the way up to $7,000 here in 2024. That can go into a Roth IRA for that grandchild. The IRA can be set up by you, it can be set up by the grandchild or the grandchild's parents, your kids. Your kids could set it up for their kid. Now, this money that you're going to give, this contribution to the Roth in this example would count as part of your annual gift tax exclusion to that person, which in 2024 is up to $18,000, well beyond the IRA contribution limit. But the really neat thing is that this strategy allows you to create a tax-free investment fund for your grandchild's future. And you can help make contributions to this account every year that they have earned income in their early earnings years. Now, your grandchild, of course, well, they can wait and have the money plus the investment returns supplement his or her retirement in the future. Or distributions in many cases can be made for a lot of other purposes. Once your grandchild has had a Roth IRA open for more than 5 years, all the distributions of income and principal are tax-free, so long as they're 59 and a half. But there's some exemptions, and the grandchild might even be able to take tax-free distributions to pay for college or graduate school, or even help purchase a first-time home, among other possibilities. So if you're already planning on leaving money to heirs, if you're potentially already gifting annually, maybe there's a way that we could gift these dollars, allow them to cook and compound tax-free for many years to come, only enhancing the legacy that you're planning on leaving. So as we're approaching the back end of the year here, I mentioned that we're already doing a lot of Roth conversions, but for those of you that are still working, maybe you're interested in taking advantage of one of these backdoor strategies, don't hesitate to reach out to your advisor. We still have time throughout the end of the year to give you some counsel on the best way to do it, if it's really advisable for you. And again, if you're planning on gifting money to family, the backdoor Roth IRA for a grandchild may be something to explore as well. As always, thanks for making me part of your week. When I come to you with these wealth reports, know that we want to stay proactive. We want to stay in front of opportunities for you. And until we speak again, all the best to you and your family.